in session. Lydia the lawyer presiding.
My gavel. Welcome to the Everything Lydia Show. And today, I have a very special guest. Mr. Charlie Massimo is going to be joining me today. We're going to be discussing the science of investing. And I have to tell you, there's a lot of people out there that don't know much about mutual funds, about not taking, I guess it's like taking a dart and throwing it at the dartboard to determine how you're going to make investment decisions. Yeah. So we're going to be going through all of that, a lot of nuts and bolts information, and a little bit more serious than usual today. So first and foremost, Charlie Massimo, thank you for being here.
Oh, it's my pleasure. Thanks for having me.
I am so impressed when I read your resume and I read about what you're doing with this what I did not even know about. It's called Dimensional Fund Advisors, kind of philosophy and fund, which we're going to go into and explain what it is. But before we get to that, can you give us a little bit of background? Like, where did you come from?
Depends on who you ask. I've been in this industry since 1984, working in finance. Mm-hmm. I got into it because I watched my dad, who was such a hardworking guy, retire with really nothing. I mean, he had gotten bad advice throughout his whole life from so-called professional advisors.
Oh, I have one of those too with my father. Same story.
Yeah, it's unbelievable. You go into the market hoping for a healthy retirement, then all of a sudden it works out very differently. Yeah. So when I left college in '84, I decided this is what I wanted to do. So I started at Shearson Lehman Brothers, spent a number of years there, then Merrill Lynch, then back to Smith Barney, which was part of Shearson at the time, and then finally in '03 I decided to go out on my own, start my own firm.
Okay, so now those firms that you had just mentioned are based upon, or I should say driven by commission, is that correct? Would you say, or this is the part that you're going to have to clarify?
No, you're right. I mean, look, there's good and bad everywhere, but primarily those big firms are driven by profitability.
Thank you. Okay, profitability there. And just so everyone knows, I'm not endorsing any particular thing at this point. I'm not a financial advisor. I love to just get information and share information and educate my audience as to, what's out there. And I'm very, very skeptical. I'm very cynical. So you're going to have a tough, road ahead of you here.
Rightfully so. I don't blame you.
So, those investment brokerages and investment houses, or whatever we want to call them, are based upon profitability. You said you went out on your own and you formed your own wealth management company, which is called CJM Wealth Management, correct?
Yes.
And tell us about how that's different than the other businesses that we had just mentioned.
And let me clarify what I mean profitability. Let's face it, if we're a business owner, we all want to make profits.
Yes, we do.
But at what expense? Mm-hmm. So when I talk about profitability at the big firms, they're worried about profitability of their own stock price. Mm-hmm. They want their stock price to go up. And the only way they can do that is selling products that are profitable for the firm, but not necessarily in the best interest of the client. Okay. So when I was at Merrill and Smith Barney, again, a lot of great things from those firms, but first and foremost, we were taught to sell product, not to really think about the best interest of the client, but to sell product. And going out on my own, I act as what many will call as a true fiduciary, where not only do I have to recommend something that's suitable, but I also have to make sure it's in the best interest of the client, first and foremost.
Okay. Now, DFA, Dimensional Fund Advisors, that's the philosophy that excuse me, your firm has adopted, correct?
Yeah.
Well, tell us about that.
Sure. Dimensional Fund Advisors, they manage about $400 billion, yet they've been called the best kept secret on Wall Street by many so-called experts and authors, and there's a reason for that. DFA goes about it very, very differently. They truly do act as a fiduciary for the clients, putting the best interests of their clients first and foremost. And again, they are a mutual fund family, like a Vanguard, like a Fidelity, like a Putnam, like a T. Rowe Price. The difference is their philosophy on how they manage money. The majority of money managers use forecasting and speculation to say, well, I think this year Home Depot's a better stock than GE. Hey, look, it's funny you say that because many years ago they did a study, Wall Street Journal,
yes, I'd read
that
about
had
that.
A monkey pick stocks versus a pro with a dartboard. And the monkey and the pro is about 50-50.
They did about the same.
They did about the same. So the point is no one can really predict the future or predict what stocks are better than the other. So DFA has a formula based off of what's called the Fama-French three-factor model. Not getting into too much detail, but it really is an amazing formula. It helps us helps us figure out what are the factors that will predict future stock prices, such as how you tilt your portfolio toward small companies versus large company, value companies versus growth companies. But instead of trying to pick one or two stocks, they basically buy the entire index, the entire universe of stocks, because no one is smart enough to predict which one will outshine the other. So they're going to try to reduce the biggest risk of the market, that is one manager totally kind of screwing up their portfolio.
Okay, so what I'm going to do now is we're going to go back a little bit because you said a mouthful there.
Yeah,
you
I
did
did
say a lot. And I know that there's so much that we can talk about with DFA because I did quite a bit of research. And when you mentioned Fama won the Nobel Prize in economics in, I believe, 2013.
Correct.
And that in and of itself, I mean, that's you're not winning a Nobel Prize based upon some gibberish, some BS, right?
Yeah,
it
no,
just
absolutely.
doesn't happen.
Yeah, his theories are.
So this DFA, or I should say DFA, is based on his theories and his formulas. Now, the way, again, I understand it, and I'd like to go back to some definitions in a minute, but what DFA was able to do, and I want to reference a particular, let's see, which one are we going to do first? I don't know if they're loaded or not, but I wanted to actually look at performance history. That's the second one. All right, so let's do.
Okay.
Let's go to hypothetical portfolio illustration, which everyone out there will see it for a quick second, but I will put it on my website, so we will be able to make reference to it. So, tell me a little bit, Charlie, about what we have in this image. You have, I see, from the year 2000 to 2015. Tell me what this shows.
Yeah, so many people call the 2000s the lost decade for stocks.
Yes.
Because if you measure it by the S&P 500, which is U.S. large company stocks, the return was basically zero. So imagine that you invested your money from 2000 to 2010 and basically made zero, right? That's because most people are under the misperception or misconception that U.S. stocks are the biggest and the brightest. While obviously we all have a bias to U.S., you have to think about the world. The entire world is growing. So again, DFA's philosophy and Eugene Fama's philosophy is how much small cap stocks do you own versus large,
right?
And how much value versus growth. But then again, diversifying amongst the world. So a typical portfolio of ours will own 13,000 stocks in 26 countries.
Oh, all right. So we're not focusing on, you said here,
Just
American
US,
companies,
right.
U.S.
So again,
That's
if
a
you
big
look
change.
at this chart, you could see $100,000 invested in the S&P 500
Right.
in 2000. By current 2015, it was worth about $105,000.
So really insignificant in terms of profitability.
A DFA portfolio is worth 3 times or $345,000. And again, it's not, investing is not very difficult. It's really sticking to a discipline, removing the emotion from the process. But the problem is, we all get tied up in what we read, what we hear, and we get spooked out of the market.
I have to tell you, I shouldn't even say this, they'll kill me, but my in-laws, for example, so emotional when it comes to investing. I mean, they're elderly and they're still in the stock market, and they literally lose sleep over hearing about the market going up, market going down, and things like that. And it's just such a shame because think about it, that's what they're dealing with at this point. They're afraid that they're going to lose all of their principal, whatever they have to live on.
Yeah, and that's because that's another thing, that these big Wall Street firms want to pry on that emotion. They want to play to that emotion because they feel that they can prove by trading the stock markets in and out, they can outguess the markets. But as some of the smartest people in the world, like Eugene Fama, Ken French, Roger Ibbotson, all guys that work with DFA and scholars, they all prove that no one's smarter than the market. The market is incredibly efficient. So trying to pick out any inefficiencies is just not worth the time and effort.
So the way I understand it then, DFA is utilizing statistics from the beginning of the stock market. So we're looking back from, I guess, the 1920s.
Yeah.
And it was able to, because also there's computers, right, that we have access to that weren't around years ago. And I guess they were able to create algorithms that were able to take this information and somehow analyze it and using these different factors and whatnot, and they were able to take the good out of the market and the I guess the benefits. And I'm really making this very simplified.
No, you're saying it right. I mean, DFA's theory is really based on empirical data that's been around for decades and decades and decades. Again, most Wall Street firms are going to hire a guy to Harvard, and he's going to sit and look through all the pieces of paper. He's going to sit with the CEO of a company, and just because he did that, he thinks he can pick if that stock's going to go up or down. Well, look what happened to AIG, Bear Stearns, Lehman Brothers, companies that aren't around anymore. So you could spend as much time as you want with the CEO. That doesn't give you any more insight than you and I.
Wow.
Right? And that's what DFA's belief is, which is why when we build a portfolio, we diversify the risk away. So there's not one stock that makes up more than 1% of the entire portfolio. So if a stock in '08, like a Bear Stearns or Lehman, goes out of business, it has minor impact on our portfolio versus a typical mutual fund that might own 5, 10, 15% in just that one stock.
Right.
Because that's a money manager making a pure guess, pure speculation. It doesn't work in the market.
Who are some clients that our audience would know about that utilize DFA? Some big companies or I think you mentioned Warren Buffett.
Yeah,
perhaps,
Warren Buffett's belief. No, you're right, because again, DFA does something which is classified as passive management, because they're not actively trading the market. 99% of all mutual funds are actively traded because they could charge higher fees.
Yeah.
They don't get better results, but they're allowed to charge higher fees because they're actively traded. So Warren Buffett, even his own will, said, when I die, I want my money being managed passively. In his own newsletter to his shareholders, he said that the best way to diversify through the market is through passively managed funds.
Which is DFA.
DFA. And they're really the only pure passively managed shop. Now, Vanguard does it, but 61% of Vanguard's assets are actively traded. So DFA is truly the only pure passively managed mutual fund available today.
Okay. And I did read an article about they did a comparison of DFA with Vanguard. And if I'm not mistaken, I would say a majority, I don't want to say 100%, because you can't trust 100% with anything, but a majority of the funds that were DFA funds had outperformed the Vanguard funds.
Yeah, and that goes back to the Fama-French three-factor model, because when you buy an index fund through a Vanguard, they're just trying to match the index. So if the index is the S&P 500, all they want to do is match it minus fees.
Yeah.
Right? DFA's goal is to beat the index, not match it, but beat it by tilting toward value and small. And for the last 10 years or more, they've been able to significantly beat their indexes.
All right, I know we kind of jumped around, but just define mutual fund. And when we talk about indexes, just generally a little nuts and bolts here. What is a mutual fund?
Well, a mutual fund is just a manager that owns a conglomerate of stocks. They might call themselves a large cap mutual fund, an international mutual fund, a small cap mutual fund. There are
so many
various degrees of mutual funds.
I think I read somewhere, and they were joking around. They said there's probably a mutual fund that focuses on building clogs in Estonia or something crazy. And then they laughed. They said, well, not really, but maybe one day.
Maybe one
day. It could be anything. It could be real estate. It could be absolutely anything.
They're called different asset classes. So mutual funds will have different representations of asset classes.
Now, there's also, you're referencing, when you're talking about index funds, what do you mean by that then?
Sure. So there are many, many index funds. There's the S&P 500, it's an index. Russell 2000 is an index. The EFA, which is the international index. Those are funds that are just trying to buy the entire index. So they're going to buy the entire S&P 500. They'll own all 500 stocks.
Right.
Or Russell 2000, they'll own all 2,000 stocks in the Russell index. But again, all they're trying to do is match the index.
Okay.
The reality is the majority of all investors don't even match an index. And there's been studies done of that. They don't even match an index, let alone try to beat it.
So this is science, and I love science. I am such a scientist. Everything, as far as I'm concerned, I just feel like if you're able to take data and you're able to plug it into a formula that actually works, and we already know that based upon the Nobel Prize that Fama got, why wouldn't everyone utilize this particular type of investing philosophy?
You know, it's a great question, but it's the same reason why no matter how much people tell you it's bad to smoke, they're still going to smoke.
They're still going to
They're
smoke.
still going to smoke.
I guess
You know,
you're right.
People believe that stock picking has to be sexy. You have to go to a big firm to be able to pick stocks successfully. The majority of people still don't understand that all you need to do is buy an entire index and you will outperform 99% of your peers. And the other two things that make DFA very successful and very different is they only act at what's called an institutional level, meaning that you can't pick up the phone and say, I want to buy your funds like a Vanguard or a Fidelity or an American Funds. They only provide it to a handful of advisors throughout the country. I'm
And you're one of them.
fortunate to be one of 1,700
Wow.
out of 250,000 advisors in the country. Now understand this, I get paid exactly the same way whether I use
Wow.
DFA, Vanguard,
Yeah.
but for me, there's no more efficient way at a cheaper cost to provide the type of returns that my clients need to retire comfortably than DFA.
Well, that leads me to my next question, and I want to show one more chart, and I want to talk about Bernie Madoff for a second. But you had just maybe we should talk about Madoff because we don't have enough time. How is DFA different than investing with someone like a Bernie Madoff? Because everyone hears about, oh, he owns a hedge fund, he's got helicopters, he's got all this money. What protections are here, and how is that any different? Because that's something that someone said to me. I'm not going to invest with anyone unless I do my due diligence and know exactly they're not going to take my money and my hundreds of thousands, my millions, and take it off and have an extravagant lifestyle. How is this different?
Yeah, no, that's exactly right. Everybody should do their due diligence, but the real difference is between Bernie Madoff or any real mutual fund, DFA or Vanguard. One, they're all publicly traded. So
and Bernie Madoff, did he have a hedge fund?
It was all. He had his own fund, whatever. Not a mutual fund. He had his own
fund.
proprietary
Clearly
trading
nothing, but,
strategy.
Okay, I see.
So
when someone wrote a check, they made it payable to his company,
to
correct?
Bernie Madoff. In our, even though we manage a little over $300 million, nobody writes a check out to us. It's written out to a custodian, which is Pershing, owned by Mellon Bank, and that's the first thing that people should make aware of. Who are you writing your check to? Two, how transparent is it? Again,
Auditing, right?
Bernie Madoff's philosophy, nobody could understand what it was. It wasn't transparent.
Right.
But they all were lured by these great returns. Again, any mutual fund company like a DFA is publicly traded, daily liquidity, meaning if you want your funds tomorrow, you can have them.
Right.
They don't write a check out to us or DFA. They write it out to the custodian. And again, the philosophy is easy to understand and explain.
So then you really can't, that can never happen. There are safeguards that you can't, that money that you give to invest in these funds are all publicly traded.
Yeah, it's
so you
highly
you can go to the
unlikely.
newspaper and basically see what your fund is doing that day.
Yeah, and the mutual fund industry is one of the highly regulated. Industries in all of Wall Street.
And there's also institutional investors that utilize DFA, correct?
Yeah, you asked that question
Yeah.
before. So AT&T, Citigroup, Bank of New York, some of the largest not-for-profits, some of the largest college endowments utilize DFA for their investment
How come
needs.
we haven't heard about this? Like, how come I don't know why. Why haven't I heard of DFA?
They did it deliberately. They didn't want to go to mainstream like a Merrill Lynch or a Wall Street or a Shears and Lehman Brothers, where they're going to actively trade their funds.
Okay.
They wanted advisors that completely understood the philosophy, were able to articulate it, and again, act as a true fiduciary. That's why they're the lowest cost provider next to Vanguard in the entire industry for doing those things.
And that's probably one of the reasons why the return is higher.
Yeah,
Because, right?
It's a great point. If everything's equal, if my cost of doing business is lower, returns are going to be higher.
Yeah. Okay, one last exhibit. There is a chart here. It says performance history, and it starts at 1972. And it shows that if you made an initial investment of $100,000 utilizing, DFA mutual funds, correct, or that philosophy, versus just having it in the S&P 500, that $100,000 in 2013 would be worth $15 million. Is that right?
A little over $15 million.
A little over $15 million, but in the S&P 500, it would only be a little over $6 million.
$6.5 million. Both numbers pretty good. Who wouldn't be happy with either? But
I'll go for the 15 versus the 6.5.
But the reality is most people don't even get the S&P return because again, advisors want to trade the markets. They just don't want to instill the discipline that an investor needs to get this. And this is why true wealth is really created in the markets.
This does not lie. This does not lie. So that's great. I have to tell you, I'm very impressed with the fact that I was very skeptical, and I see now that this is an incredible philosophy as far as investing is concerned. I definitely want to learn more.
Great.
Who is your client? Who would you want to be, out there? If there's anyone who would, if they can get in touch with you, who's your client?
Well, our typical clients are business owners, entrepreneurs, professionals, somewhat people that kind of are in this for the long term. They understand they can't trade the markets. We obviously have a net worth minimum, but we're more interested in adding value to a relationship, and that first and foremost we look at in any relationship, that can we add true value.
All right. So if anyone does want to get in touch with you, how can they do that?
CJMwealth.com, and we're located in Deer Park, 631-777-1030.
And did you mention your website?
Yeah, CJMwealth.com.
.com,
Also just published the book, which is available through Amazon. It's called Getting Off the Street, and it's my story about on Wall Street and then why I left Wall Street and the discipline that we utilize now at CJM.
Love that. I have to tell you, I love these best kept secrets in industries. That's wonderful. Thank you, Charlie, for being here.
Oh, thank you so much.
And maybe we'll do a part two, and we'll do the part two of the education session here.
I look forward to it.
So thank you, everyone, for joining us. And if there's any part of this show that you might have missed, please go to www.thedailyblue.com. And also, I think it's on YouTube, so we're going to see it on there as well. And visit us again on Mondays at 2:30, where you will see either a new show or possibly even this show one more time. So remember, everyone, to go check your ordinary at the door, go live that remarkable life, and we'll see you soon. High five.
Thanks.